Good morning, everyone. You are welcome to today's class. And this will be our first class for preparing tax computations and returns. This is the task for ATS3 at the ATS level. And we are preparing you guys for your final exam. And by God's grace, we pray that you qualify this diet. Okay. So before we go into our topic of this course, we are going to take ourselves through the course content for these nights. Okay, so again, the course is preparing tax computations and returns. Under this course, we are going to look at the following. One, the introduction and background to taxation. Introduction and background to taxation. Here we are going to look at taxation history in Nigeria, Ghana, and Liberia. Okay, so also we are going to take a look at the canons or principles of taxation and some other ones. Also, we are going to discuss the general administration of taxes, who administer taxes. For instance, in Ghana, Ghana has a central administration of tax. Okay, unlike Nigeria, where we have the federal administration, we have state administration, and we have the local government administration. In Nigeria, at the federal government level, we have the Federal Inland Revenue Service administering the collection of taxes and remitting the fund to the Central Bank of Nigeria into the federation accounts. And at the state level, each state has their own internal revenue service administering their taxes. And at local government level, we have the local government revenue authority. Okay, so after that, we are going to look at the basis of assessment. How do we assess an individual or corporate entity into tax? On what basis do we assess a corporate organization or an individual into tax? Also, we have our capital allowances. Yes, capital allowances is an allowance, is a tax allowance in lieu of depreciation to taxpayers that have acquired qualifying capital expenditure during an assessment year. Capital allowances is a tax allowance that is granted in lieu of depreciation to taxpayer that has acquired qualifying capital expenditure in a particular assessment year. Also, we have personal income tax. In chapter 1, we are going to discuss the type of taxes we have. Okay, so we have direct tax and indirect tax. A good example of a direct tax is the personal income tax or the income tax. So under the income tax, we have the company income tax and we have the personal income tax. Okay, so personal income tax is a type of tax that we are assessed on individual. Okay, so individuals are assessed based on their personal income. Based on their personal income. Simply put, the tax law that governs the taxation of an individual is the Personal Income Tax Act. That's in Nigeria. Also, we have taxation of incomes of partners in partnerships, taxation of income of partners in partnership. Okay, so now let's take taxation of incomes of partners in partnerships. For partners in a partnership business, of an individual that enters into a partnership agreement. The basis of taxing a partner or an individual in a partnership agreement is quite different from that of an individual operating as a sole proprietorship. Okay, so for instance, now, if 4 individuals come together to form a partnership business, for instance, a firm of chartered accountants, the firm will not be what will not be, if, for instance, now, if the firm is registered as a business enterprise, not a limited liability company, okay? Because usually prior to the introduction, prior to the amendment of CAMA 1990, what we used to have is that for every partnership business, they are registered as what? As a business enterprise, okay? But with the CAMA 2020, partners or individuals going into partnership business can now register as a limited liability company, okay? So then, if you are to assess individuals in a partnership business into tax, we assess them on their income, that is their profit sharing, okay? So partners will only be assessed on the ratio of profits received during that particular assessment year, okay? So not on the whole income or profits of the firm, okay? Because business enterprises do not pay income tax. Rather, tax will be what will be assessed in the hands of the owners of business. And since the partners are in a partnership agreement are owners of the business, so they pay tax on the income they get from the company. Is that taken? Okay. Next is the company's income tax. Company's income tax. Like I mentioned earlier that we have 2 types of taxes, the direct tax and indirect tax. So under the direct tax, we have the personal income tax, company income tax, and we also have the capital gains tax and the likes. Okay, so now here, companies are assessed to tax based on what? Based on their assessable profits. Okay, so firstly, you need to determine the adjusted or assessable profit of the company. Then you adjust for any unrelieved losses brought forward. If you have any unutilized capital allowances, you claim that, and also capital allowances for the year, in as much that it does not exceed 66 2/3 of the assessable adjusted profit for that particular assessment year. However, for companies that are exempted, such as manufacturing company and agricultural company, they are what? There is no restriction to the capital allowance that you can relieve for a particular assessment year. Only that where the capital allowance or total capital allowances for a particular assessment year exceeds the what? Exceeds the adjusted or assessable profits, where the total capital allowances for a particular year for manufacturing company and agricultural businesses exceed the adjusted or accessible profits for a particular assessment year, you cannot relieve more than the adjusted or accessible profits you have for that particular assessment year. So after doing this, you arrive at your taxable profits. You arrive at a taxable profit on which you apply the applicable tax rates. So for Ghana, Ghana has different tax rates it's used for what? For companies in different sectors. Okay, so Ghana has specific tax rates is using for every companies in particular in a different sector. Okay, so but generally the tax rate in Ghana is 25%, while in Nigeria, prior to the amendment of the Finance Act of 2019, prior to the introduction of the Finance Act of 2019, what we used to have is a flat rate of 30% for every company, except for small companies, that is companies with turnover of less than 1 million naira. And this type of company, we pay a minimum income tax at the rate of 20%. We pay minimum income tax at the rate of 20%. But with the introduction of the Finance Act of 2019, the Finance Act of 2019 classified companies into three. Okay, so this category of companies are: one, small company, the companies that has a turnover, a total annual turnover, an annual turnover of between 0 and 25 million naira, or companies with turnover of 25 million naira are exempted from tax, are exempted from the company income tax. In other words, their tax rate is 0%. And you know what? When your tax rate is 0%, if you have 100,000 taxable profits, 100,000 multiplied by 0, what do you have? You have 0. Anything multiplied by 0 will give you 0. Are we together? Okay. And we have medium-sized company. For tax purpose, companies are classified as medium-sized if they have turnover of between 25 million and 900 million. Okay, meaning that the range of 25.001 million, 25.01 million, and 99.99 million. So any company that falls on this range, we have to pay tax at the rate of 20%. And also we have the large company, and these are companies with turnover of 100 million naira and above. That's for companies income tax. Also we have loss reliefs. Yes, loss reliefs is for companies that incur losses within its first 4 years. Okay, within its first 4 years of operation. Okay, so this type of company is likely to be exempted from the payment of companies' income tax. However, they may be subject to minimum income tax. That is, companies that incur losses subsequently may be incurred for the payment of company income tax and minimum income tax. However, before they can be of minimum income tax, they have to prove to the tax authority that they are in their first 4 years of operations. Hence, companies that incur loss in a particular year of assessment, they have to pay the minimum income tax. They have to pay minimum income tax, except where the company is in its first 4 years of operation. Are we together? Also, a company cannot relieve more than the losses incurred in previous year, and cannot relieve more than the adjusted or accessible profit you have for that particular assessment year. Are we together? Okay. So also we have taxation of specialized companies. Taxation of specialized companies. Are we together? So banks, insurance companies, telecommunication companies, airline companies are all classified as special businesses. Okay, and as such, they have peculiarity in their computation of tax. Okay, they have peculiarities in their tax computation. Together, okay. So, and when we get there, we look into that in detail. Also, we have the withholding tax. Yes, withholding tax is an advance payment of tax. Is an advance payment of income tax. Withholding tax is an advance payment of income tax. withholding tax is an advancement of income tax. Okay, for instance, now specific transactions. Okay, so there are transactions that are subject to, if you have dividend income, if you have dividend income, okay, so this dividend income is a transaction that is subject to withholding tax. Is a transaction that is listed under the withholding tax table. Okay, so for this reason, withholding tax of 10% will be deducted at source. That is, the payer of the dividend should deduct 10% of the dividend before paying the what for payment. So now the beneficiary of this payment, who is, for instance, B, has suffered 10% from the dividend received. For instance, now if the dividend received is 1 million naira, 10% of 1 million naira is 100,000 naira. So payer A must have deduct 100,000 naira from the 1 million naira and remit same to the tax authority on behalf of B, because it is an advance payment for B. Do you understand? It is advance payment income tax for B. So B can then use 100,000 to offset its future tax liability, to offset its future income tax liability. Please, can only be used to offset income tax. Withholding tax can only be used to offset income tax. So it could be your personal income tax or company income tax, depending on what? Depending on the transactions it was deducted. So if the transaction is between an individual or between corporate organization, okay. So for instance, now if B is a corporate, okay, so he can only use the withholding tax to offset his company's income tax. Okay. However, if he is an individual and the withholding tax has been deducted as source, irrespective of who deducted the money, whether the payer is a corporate organization, so much in as much that the beneficiary is an individual, such withholding tax will be used in offsetting B personal income tax together. And we have capital gains tax. This is a tax that is being charged on disposal of disposal of on disposal of assets. Okay, the capital gains tax is a tax that is charged on what? On disposal of capital assets. Are you together? So, for instance, now, if there is disposal of building, okay, if there is a disposal of building which capital allowance has been previously employed, or which capital allowance has previously been employed, after computing the balancing charge and balancing allowance, bonus demands that the seller computes capital gains tax and remits them. So you compute capital gains tax on the sales proceeds. You compute capital gains tax on the sales proceeds and so we also have value added tax. Value added tax is a type of an indirect tax. Value added tax is an indirect tax, and it is charged on consumption of goods and services. It is charged on consumption of goods and services. Are we together? Okay, also we have tertiary education tax. This is for Nigerian candidates only. Tertiary education tax is a tax at 2% payable on accessible or adjusted profit. Tertiary education tax is 2% of adjusted or accessible profit. However, the Finance Act of 2021 has reviewed the tertiary education tax rate upward from 2% to 2.5%. But for exam purpose, your tertiary education tax is 2% of adjusted or accessible profit. Are we together? Okay. And next is the gift tax. Uh, this is applicable to Ghana candidates only. This is for Ghana candidates only. Okay. And last on the list is the stamp duties. Stamp duties. This is a type of tax or levy paid on what on agreements drafted between two or more parties. Okay, it is a levy or tax paid on what on legal documents. Are we together? Also, and at the end of uh the whole class, we are going to have a revision class. Okay, so whereby students interact with their lecturer, they ask questions on areas that are unclear to them or areas that they need further explanation. Are we together? Okay, so now let's start with the introduction and background to taxation. Okay, so now let's share our class notes slide. So I believe you can all view my screen. Okay. So in today's class, we are starting with introduction and background to taxation. Under this topic, we are going to take a brief introduction of the course, and also we are going to give some definition of taxation. Okay, so definition from different scholars. Are we together? The essentials of a good tax system will be discussed. Tax courts, the Nigerian tax system, historical background of taxation in Nigeria, brief history of the introduction of taxation in Ghana, objectives of taxation, tax administration in Nigeria, tax administration in Liberia, tax law, taxes in Republic of Liberia, persons regulated by tax legislation in Liberia, the principles of taxation will be discussed, classification of taxes into tax subjects, tax base, distribution of tax burden will be discussed in today's class as well. Also, sources of tax laws, distinction between taxes and levies, basic concepts in taxation, goods and services tax in Liberia. And at the end of the whole subtopic, we are going to take a summary of whatever we have discussed so far in the class. Are we together? Okay. So at the end of this class, you guys are expected to understand the meaning and historical background of taxation, classification, objectives, and principles of taxation, and sources of tax laws So what is tax? Okay, so before we define taxation, so what do you understand by the word tax? Okay, so thank you. And now, simply put, tax is a compulsory levy or financial charge imposed on a taxpayer or upon his property by the government to provide security, social amenities, and other amenities for the well-being of the society. Again, tax is a compulsory levy. Tax is a compulsory levy or financial charge imposed on a taxpayer upon his property by the government to provide security, social amenities, and other amenities for the well-being of the society. Are we together? Okay. Hope you guys are following. So the main purpose of taxation is to raise funds to defray the expenses incurred for the common interest of the country without reference to special benefits conferred. Without reference to special benefits conferred. Are we together? Okay. So the levying of tax is what is a taxation. Okay. So the levying, the administration of tax is what is a taxation. Are we together? So now let's look at uh definition of tax from different scholars. Okay, so let's take the definition of tax from different scholars. Just like we mentioned earlier, that in simple terms, tax is a compulsory contribution levied by a sovereign power on the incomes, profits, goods, services, or properties of individuals and corporate persons, trust, and settlements. Okay, for instance, now, if you're walking into a supermarket to get some items for yourself, for all valuable goods you are purchased or consume, you have to pay VAT at a particular rate. Okay, so the VAT you are paying is not going to be borne by the supplier or by the supermarket, hence is going to be borne by the consumer, the end user. Okay, so if you are purchasing, if you are buying for consumption, it therefore means you are paying the VAT on the products you are getting. And if you are buying for the purpose of resale, and it therefore means that you are going to transfer the burden of that VAT to the end user. Are we together? So it is a compulsory contribution levied by a sovereign power on the incomes, profits, goods, services, or properties of individuals and corporate persons, trusts, and settlements. The government of Nigeria, like others in different parts of the world, has legislative powers to impose on its citizens any form of tax and at whatever rate it deems appropriate. Recently now, the education tax rate that used to be at 2% before has now been reviewed upward to 2.5%. The Finance Act of 2019 also amend the section of that, and also amend that section of VAT rates, and review it upward from 5% to 7.5%. So which became effective in year 2020. Okay, so before our VAT rates used to be 5%, but now it has been reviewed upward to what? To 7.5%. To 7.5%. Are we together? So the government has what? Has the legislative powers to impose on its citizens any form of tax and whatever rate it deems appropriate. Okay, so a review of the Nigerian tax law shows that no attempt has been made to define the term tax. However, the Oxford Advanced Learner Dictionary defines tax as money that has to be paid to the government so that it can pay for public services. So that it can pay for public services. So such taxes, when collected, are used for carrying out governmental functions such as maintenance of law and order, provision of infrastructure, health, and education of the citizens, or as a physical tool for controlling the economy. So if you study in Nigeria, you notice that in all the public universities, and polytechnics as well as college of education. There is you must have noticed the tertiary education trust fund. Okay, so each school or each institution has what? As for instance now, the university, okay, the university has what? Has 50%, has 50% of what? Of the tertiary education trust fund. Okay, so why the balance is shared between the polytechnic and the college of education. Okay, so that's that for the education task. Okay, so and the reason for this, the purpose of this education task is what? Is to improve educational facilities. Okay, so money are being disbursed from the education trust fund to each tertiary institution to finance their educational facility projects. Okay, so other definitions can be gleaned from judicial precedents, and in Matthew versus Shikori Marketing Board of Victoria, Australia, the last time Chief Justice defined tax as a compulsory exaction of money by a public authority for public purposes, or taxation is raising money for the purpose of government by means of contributions from individual persons. Taxation is raising money for the purpose of government by means of contributions from individual persons. In the American case of United States versus Butler, Justice Roberts stated, a tax in the general understanding of the term and as used in the Constitution signifies an exaction for the support of the government, from the support of the government. And don't forget that paying tax, we all agree that tax is not a voluntary payment. It is a compulsory payment. It is a what? It is a compulsory payment. And payment of tax doesn't mean that you have direct benefits from the government. Okay, so payment of tax does not bring direct benefit from the government to the taxpayer. Are we together? So the most important thing is that it is a pecuniary burden laid upon individuals or persons or property to support the government, and is a payment exerted by legislative authority, unlike levy, okay, that you pay in exchange for a particular service. Okay, so tax is different. Are we together? So in other words, tax is described as a form of levy imposed on all the residents living in as well as non-residents doing business within a tax jurisdiction. It is a civic and patriotic responsibility of citizens to pay taxes imposed, which also come to the government as income or revenue yielding device to finance the provisions of social, economic, and infrastructural amenities, and also to enhance industrial efficiency. Are we together? Now let's take a look at the essentials of a good tax system. Essentials of a good tax system. A good tax system should, however, create jobs, and a tax rise should lead to arrest of wasteful expenditure. It is important to note that no one pays tax with a smile, even though taxation is a means of making the private sector pay for the services rendered by the public sector. It helps in shaping and directing economic activities, stimulating economic activities, redistributing financial resources, and using the income generated to finance social welfare. Are we together? So that's the importance, the quality, the attributes of a good tax system is to what? Is to use the proceeds to shape and direct the economic activities, stimulate economic activities, redistribute financial resources, and use the income generated to finance social welfare. Is that what we have in today's government? Okay, so now let's take tax cuts. The term tax cut means that the government takes away less of people's own money so as to enable them spend more of their money in accordance with their choices, instead of government taking it from them to make the choices for them, especially where accountability for taxes collected and spent left much to be desired. I will understand. So the payment of tax has been institutionalized with the growth of the government's responsibilities to the citizenry. So the tax cutting is not about government giving anything back to the people. Tax cutting is not about government giving anything back to the people. Okay. Now, let's take a look at the Nigerian tax system. Nigerian tax system. The tax system usually involves a The tax system usually involves a tripartite aspect, namely tax policy, tax laws, and the tax administration. The tax system usually involves a tripartite aspect, namely the tax policy, the tax laws, and the tax administration. Now let's take these one by one. We start with the tax policy itself. Tax policy is a general statement. Okay, tax policies are general statements of intention which guide the thinking and the action of all concerned towards the realization of the set goals. They usually include movements of emphasis from income tax to consumption tax, which is less prone to tax evasion, pursuance of a tax law regime with the aim of reducing individual tax burden, widening the tax net and encouraging savings and investments, and introduction of the self-assessment scheme to encourage taxpayers' participation in the tax assessment process, which is considered to be realistic in approach. The policy can also include movements from coercive method of taxation to voluntary compliance, as in the case of Nigeria of recent. Yes, in 2015, we have debates. That's the voluntary declaration of assets and income. And also we have recently, okay, recently the tax authority published a circular on waivers of interest and penalty on previous year returns. Okay, on previous year returns. Now, the reason for all this is to what? Is to bring more taxpayer into the tax net. Is to bring what? Is to bring more people into the tax net. Okay. So, one of the reasons why people evade taxes is because of what? Is because of it's due to difference. It depends on the person of perspective. Okay. So some say that, okay, they could not see the impact of the taxes collected by the governments in the area. There's no development, there's no facilities, there's no modern facilities, that they are just doing things by themselves. For instance, now, if you go to a particular community, they will tell you that the transformer was bought with the community money, the electricity poles were bought with the community money, that government has done nothing. Government has what? Has done nothing for them. Government has done nothing for them. So they will tell you that it is the effort of the community leader that they have a good road. Okay, so these are things that is happening in our rural area that make most taxpayer living in this area to evade tax. Okay, so some people would say to the extent that, okay, if they pay this tax, that was what assurance they have that this tax will be used for infrastructural development, that they do not have that assurance that their money we speak or that their money we work for them. Okay, so because to them these tax payments is what is distributed among people at the top. Okay, so it's like they're siphoning those funds. Are we together? So that's just why government needs to come with different policy. Okay, in the Finance Act, we have the policy that, okay, let's exempt some companies from the payment of income tax. Okay, now how do we do that? Companies were classified or categorized into three. We have the small company, the medium-sized company, and the large company for tax purpose. Okay, with a threshold of 25 million naira. Are we together? Okay, so that's that. For VAT too. Okay, small companies are exempted from payments of VAT. So these are tax policy. These are what? These are tax policy. Are we together? Okay. Now the value-added tax rates was what was reviewed upward from 5% to 7.5%. So these are tax policy. Are we together? Okay. So now let's look at the tax laws. Okay, so tax laws include the following notable tax legislations in Nigeria. And don't forget that these are laws guiding the administration of each type of tax in Nigeria. Okay, so we also have that for other countries too, such as Ghana and Liberia. Now let's take that of Nigeria. In Nigeria, we have the Personal Income Tax Act, Cap C21, Law of Federation of Nigeria 2004, as amended. We have the Companies Income Tax Act, Cap C21, Law of Federation of Nigeria 2004, as amended. We have the Petroleum Profits Tax Act, Cap P13, Law of Federation of Nigeria 2004, as amended. We have the Capital Gains Tax Act, Cap C1, LFN 2004, Value-Added Tax Act, Cap V1, Volume 1, Law of Federation of Nigeria 2004, as amended. Tertiary Education Tax Act, Cap E4, Law of Federation of Nigeria 2004, and the Stamp Duties Act, Cap 58, LFN 2004. So in Nigeria, the Constitution vests the legislation of income tax, whether personal or corporate, on the federal government in order to promote uniformity. However, the administration of the various taxes is chaired by the tiers, by three tiers of government. The tax laws are reviewed periodically in line with the changes in social, political, and economic conditions of the country. Okay, so now recently the government is saying the government of Nigeria is saying that because of the increased consumption in carbohydrated drinks, okay, now they are placing 10% excise duty, 10% excise duties per liter, okay, per liter of carbohydrated drinks. Are we together? Per liter of soft drinks. Now, that's a tax policy. Okay, that's a tax policy, and will be backed, okay, by the Customs and Excise Duty Act, with the Customs and Excise Duty Act. Are we together? So the power to impose tax in Nigeria is within the exclusive legislative authority of the federal government. There are various machineries set up by the government to ensure strict compliance of these laws, and non-compliance attracts penalties and fines. So lastly, let's look at the Nigerian tax system. Tax administration under the Nigerian tax system. This involves practical interpretation and application of the tax laws. The bodies charged with the administration of tax in Nigeria are the federal, the state, and local governments. The tax authorities of these tiers of government derive their formation from the federal laws, which include 1. The Federal Inland Revenue Service Board, Sections 1, 2, and 3 of the Companies Income Tax Act, and 2, the Board of Internal Revenue, State Board of Internal Revenue, Sections 35A, B, and C of Personal Income Tax Act as amended. And we have the Local Government Revenue Committee, sections 85D and E of personal income tax as amended. Are we together? Okay, so just like we mentioned at the start of this class, that in Nigeria, we don't have a centralized tax administration such as that of Ghana. Okay, so in Nigeria, each tiers of government has its own its own tax administrator. So for the federal government, we have the Federal Inland Revenue Service, and for the state government, we have the State Board of Internal Revenue, and for the local governments, or at the local government level, we have the Local Government Revenue Committee. Are we together? So unlike that of Ghana, where we have just the internal revenue of Ghana, okay? Now we are moving forward. Now, so let's take a look at the brief history of the of taxation in Nigeria. Brief history of taxation in Nigeria. Taxation dated back to 1904 when late Lord Lugard introduced income tax in Nigeria. It started as a community tax which later culminated in the Native Revenue Ordinance in 1917. In 1918, an amended ordinance extended the provisions of 1917 ordinance to southern Nigeria. The first ordinance applied to Abeokuta in Ogun State and to Benin City in Edo State, and in 1928, it was extended to eastern Nigeria. The Nigeria income taxation did not start until 1940, when the Native Revenue Ordinances of 1917, 1918, and 1928 were incorporated in the direct taxation under Ordinance number 4 of 1940, Cap 54. Now, this ordinance repealed the Native Revenue Ordinance Cap 74 in the 1923 edition and the Native Direct Taxation Ordinance number 41 of 1937. Okay, so this ordinance was, however, discriminatory as it applied to natives in Nigeria elsewhere, that is, other than in the township of Lagos. However, a more comprehensive income tax ordinance number 29 of 1943, which came into effect on 1st April 1943, governed the assessment of the income of non-Africans resident outside Lagos, as well as Africans and non-Africans residents in Lagos. After the income tax ordinance of 1943, there was no significant change in the tax system until 1956. Until 1956. Okay, so taxation was first, okay, before now the determinant of the taxable income, or better still, the original Inland Revenue Department, was the resident, then as at 1956. Okay, so the resident was the officer appointed by the government to be in charge of the province, together with any other authorized by the authorized by who? Authorized by the resident to perform any duties imposed upon the residents under the ordinance. The chief elders law was recognized as the tax collector. However, the northern region did not pass its own personal income tax law until 1962. All the regional tax laws later formed the basis of personal income taxation in all the states that were created out of the regions. In the Federal Territory of Lagos, the Income Tax Ordinance 1943 remained in force until the Personal Income Tax Lagos Act 1961, enacted by the federal government. It was the 1961 enactment that gave birth to separate laws on income and profits of both individuals and companies, namely Income Tax Management Act and Companies Income Tax Act. The Petroleum Profits Ordinance was passed in 1959, but took effect from 1st January 1958. So many laws have been passed to date on taxation in Nigeria. So now we have the Stamp Duty Act, okay? We have the Value Added Tax Act or Good Service Tax, okay? Among others, we have the Capital Gains Tax Act as well, okay? Now let's go to Ghana. Brief history of the introduction of taxation in Ghana. Brief history of introduction of taxation in Ghana. Taxation was first introduced in Ghana, then Gold Coast, in 1943 by the British colonial government at a time when the World War II was raging. It should be noted, however, that before the introduction of income tax in 1943, several attempts had already been made. For example, as far back as April 1852, the poll tax ordinance was passed to raise money to finance the increased cost of British administration. Under the ordinance, every man, woman, or child residing in districts under British protection was to pay 1 shilling per head per year. These early experiments of the introduction of direct taxation failed because of weaknesses inherent in the system of collection and the fact that the first proceeds were mainly used to pay the increased salaries of British officials and not for the construction of roads and schools. Okay, so this discouraged the people then, and the first income tax law was the Income Tax Ordinance number 27 of 1943, since that of 1852. So this ordinance was modeled to a large extent on the general principles underlying the Income Tax Act, then enforced in the United Kingdom. It imposed the tax generally on incomes having their sources in Ghana, so that foreign source income was not liable unless it was remitted to Ghana. One characteristic feature of this ordinance was the numerous personal reliefs and deductions that it contained. Since then, the income tax law has seen several changes through amendments and modifications, such as the Income Tax Amendment Ordinance 1952. The first consolidated edition of the Income Tax Ordinance was published in March 1953. The following acts then introduced amendments to the consolidated edition, Act 68 in 1961, followed by Acts 178 and 197 in 1963, Act 312 in 1965. The second consolidated edition was published in September 1966, the Income Tax Decree 1966, number 78. The current income tax law is the Internal Revenue Act of 2000, Act 592. Okay, so many laws have been passed to date on taxation in Ghana. So we also have the goods sales tax. Are we together? Now, what are the objectives of taxation? Objectives of taxation include the following: for revenue generation to meet the needs of governments. Okay, so taxes are collected to meet the needs of governments. Okay, so for government to run their offices. Also, to provide physical tools for stimulating economic growth and development, for social function such as redressing the rural-urban population drift, curbing environmental pollution, as well as promoting a decent society, and to redistribute income, wealth, in order to reduce inequality. This is achieved mostly through the progressive tax. This is achieved mostly through the progressive tax. A typical type of progressive tax is the personal income tax, where we have a graduated tax rate. We have a graduated tax rate in Nigeria. Our personal income tax table we have the first 300,000 at 7%, the next 300,000 at 11%, the next 500,000 at 15%, the next 500,000 at 19%, the next 1.6 million at what? At 21%, and anything above 3.2 million at 24%. This is a progressive tax or a graduated tax rate. Are we together? Okay. Now let's look at the tax administration in Nigeria. Tax administration in Nigeria. This involves practical interpretations and application of the tax laws. The bodies charged with the administration of tax in Nigeria are the federal, the state, and the local governments. The tax authorities of these tiers of government derive their formation from the federal laws, which include Federal Inland Revenue Service Board Establishment Act 2007, the State Board of Internal Revenue Service, Section 85A, B, and C of Personal Income Tax Act as amended, the Local Government Revenue Committee, Section 85D and E of Personal Income Tax as amended. Are we together? Now, let's look at the tax administration in Liberia. Tax administration in Liberia. The Revenue Code of Liberia 2000 governs taxation in the Republic of Liberia. The Revenue Code of Liberia 2000 governs taxation in the Republic of Liberia. Every person is obliged to pay the taxes that the person is liable, and no one person may be required to pay taxes that are not provided for by the Revenue Code 2000. Taxes in Republic of Liberia include A, the personal and business income tax, the goods and services tax. Republic of Liberia include the personal and business income tax, the goods and services tax, the excise taxes, custom duties, and the real property tax. Are we together? Okay. So these are the taxes in Liberia. So in Liberia, the real property tax is 0.33%. Is 0.33% or 0.33%. Do you understand? So this would mean that whoever owns the real property as of January 1st shall be considered as the one liable. Okay, so the owner of the property at the beginning of the year, okay, are considered are to pay tax at 0.33%. Are we together? Okay, so that's for the Liberia Revenue Authority. And also the personal and business income tax in Liberia. Okay, so they have for non-residents, okay, it is 15%. Okay, so the current corporate income tax rate in Liberia is 25%. Is 25%. The current corporate income tax rate in Liberia is 25%. So foreign companies operating in Liberia may find it challenging to deal with the complexities of the country's tax system. Okay, so the primary concerns for a foreign company that needs to comply with tax laws in Liberia are individual income tax for employees in Liberia, social security costs, goods service tax, withholding tax, business tax, and permanent establishment and concern. Are we together? Are we together? Okay. So just like I mentioned earlier, the current corporate income tax is what is 25%. And for personal income tax, if you have your gross income between is 0 to 70,000 Liberian dollar, your tax rate is 0%. And if you have between 70,000 and then 200,000 Liberian dollar, you have a 5% tax rate to pay. And if you have between 200,000 to 800,000 Liberian money, you have 6,500 Liberian dollar plus 15% of the money to pay. And likewise, for anything above 800,000 Liberian dollar, you have what? You have 96,500 Liberian money to pay plus 25%. Are we together? So they don't have a payroll tax. Okay, they don't have payroll tax, and their sales tax is at 7%. Are we together? Their sales tax is at what? Is at 7%. Are we together? Okay. So let's continue. Now, still under tax administration in Liberia. Who are the persons regulated by tax legislation in Liberia? The following persons are involved in the operations of the Tax Code of Liberia 2000. Natural and legal persons considered taxpayers in accordance with this code. All persons considered tax agents in accordance with this code. Tax offices, agencies, and their employees, including offices, agencies, and employees of the Internal Revenue Services, customs offices, agencies, and their employees, in cases where responsibility for the collection of tax or tariff under the Revenue Code develops upon Commissioner of Customs, the Ministry of Finance, finance agencies, in cases where tax receipts, collection, or withholding responsibility assigned by the code to finance agencies. Other agencies and officials responsible for tax collection, receipt, or enforcement, members of the Board of Tax Appeals, and any other persons whose rights and authority are determined by the code. So these are categories of persons regulated by tax legislation in Liberia. Are we together? Okay. So let's take the principles of taxation. Principles of taxation. Yes, first we have the principle of certainty. We have the principle of certainty. It is important that the taxpayer should know the exact amount he or she is expected to pay. It is important that the taxpayer knows the exact amount he or she is expected to pay, the basis of the taxation and the rate of tax applicable, and the relevant tax authority to pay to. So that's why all these are what are spelled out in the tax law. For instance, in Nigeria, the company income tax specify the relevant tax administrator, which is the Federal Inland Revenue Service. Okay, which is the Federal Inland Revenue Service. And for personal income tax, the administrator of the personal income tax is the state, which is represented by the State Internal Revenue Board and State Board of Internal Revenue Service. And also we have at the local government level, we have the Local Government Revenue Committee. So this is a good example of certainty in the tax law. Okay. Also, this taxpayer should know what tax they are paying. Okay, so if you are paying personal income tax, at what rate? So that's why we have our personal income tax table. If I'm paying company income tax, at what rate? Okay, so our tax law is certain. And we have economy in collection cost. The cost of collecting taxes should be relatively lower than the amount of tax collected. Yes, the cost of tax administration should not exceed the benefits from these tax collected. Are we together? So also there should be convenience in the payments of tax from taxpayers. Okay, so the method and timing of tax payment must be convenient to the taxpayers. It must be easy to locate the taxpayers. Are we together? Okay, so and thank God, kudos to our to the Federal Revenue Service for coming up with the tax promise. So on the tax promise platform, you can now pay your tax at your at any time of the day from the comfort of your zones of your home. Okay, so you can be on your bed and pay your tax as I want you. Okay, so that's conveniency in the tax payment and tax administration. You can file your returns on the tax forms without going mad. Okay, so also there should be efficiency. Both the compliance and the administrative costs must be kept lower than the revenue raised in order to avoid any resentment from the taxpayers, especially those of them with smaller income or those living in the rural area. Are we together? And also there should be equity or equality in the tax law. Okay, so taxes should be seen to be fair in order to gain acceptability of the taxpayers. It is important that attention be paid to vertical equity and horizontal equity. What is vertical equity? This involves a system whereby the rich pay higher than the poor. Okay, so and a good example is that of the personal income tax. Okay, and thank God in our company income tax too in Nigeria, we also have the graduated tax rates. Also in Ghana, for some sector, we have specific tax rates, even though the general tax rate is at 25%. Are we together? Okay, so why the horizontal tax, horizontal equity is a situation which requires equal treatment to people in similar situations. Okay, so for instance, now, if your turnover is 26 million, you pay tax at 20%. And if your turnover is 99 million, you pay tax at 20%. So irrespective of you having more revenue than the other, okay, so you are to pay the same tax rate. So this is an example of horizontal equity, but a good example of this, okay, a good example of this is the value added tax. Okay, a good example of the horizontal equity is the value added tax, because irrespective of who you are, whether you are rich or poor, in as much that you transact a vatable goods, in as much that you consume a vatable goods, you pay VAT at 7.5% in Nigeria. Okay, in Liberia, you pay what? You pay your sales tax at 7% on taxable goods and services. Okay, that's just it. Okay, so that's a good example of horizontal equity in the tax law. So the more goods you consume, the more VAT you pay. So, and also there should be flexibility in our tax system. The tax system must be flexible for it to serve as a veritable fiscal tool. The rate of tax should be capable of being altered without much difficulty. Then neutrality, the last is neutrality. A good tax system should not distort the economic choices in any form as to cause excess tax burden. Taxes should be neutral and should not be made to impinge adversely on economic activity. Are we together? Okay. Now let's look at classification of taxes. Classification of taxes. There are various ways in which taxes can be classified, depending on the perspective at which one is looking at taxes. One can classify taxes from the perspective of the tax subject, the tax base or the distribution of the tax burden. Are we together? So now let's take these one after the other. We are starting with the perspective of tax subjects. Here we have the direct and indirect taxes. Now we are taking the direct tax. This type of tax is levied directly on the taxpayer's income. An example includes companies' income tax, pay as you earn, and capital gains tax, among others. And for indirect tax, this is levied on goods and services. Indirect tax is levied on goods and services. A good example is the value-added tax in Nigeria and goods sales tax in Liberia. It could be specific, in which case a fixed amount is imposed on a commodity per unit, or it could be ad valorem if the tax levied is a certain percentage of the cost of the commodity. For instance, now I've mentioned the new tax on carbohydrated goods, okay, and carbohydrated drinks, such as soft drinks and the like. So we have 10% per liter, 10% per liter. So that's excise duties, 10% per liter. So this is what this is imposed per unit. So that's that. Now let's take advantages and disadvantages of direct taxes. Advantage and disadvantage of direct tax. Let's start with the merits. These include, but not limited to, lower cost of collection. Yes, direct taxes has lower cost of collection. It is more equitable as the taxpayer with higher income bears a greater burden, and it is easier to ascertain tax incidence. So if you have 100 million in Nigeria, you pay what? You pay 30% tax. And under the personal income tax, if you have your annual income to be more than 3.2 million, then you pay 24%. And don't mind, you start from the first 300, next 300, next 500, next 500, up to anything above 3.2 million at 24%. Okay, so this means that the more money you have, the more income you earn, the more tax you pay. Are we together? Now, what are the disadvantages of this direct tax? These include, but not limited to, discouraging hard work. It may give room for tax evasion, especially if the tax rates are high, and it may cause social unrest, especially if the tax rates are very high, since the taxpayers bear the whole burden. Since the taxpayer bear the whole burden, unlike indirect tax, where the burden is borne by who? By the consumer of the goods or services. That is the end user of the goods or services. Are we together? Now let's look at the advantages and disadvantages of indirect taxes. For indirect tax, the following are the advantage. A good source of revenue to government, because except if you stay away from the consumption of that particular valuable goods. Okay, so without that, there's no way you can run away from that tax. You cannot evade it. Okay, so it can be adjusted easily. It is veritable physical tool to check pattern of consumption of undesirable goods. It can be used to protect infant industries, and it is more difficult to evade. Demerits include the cost of collection may be higher, where there is collusion between tax officials and taxpayers to evade tax. There could be loss of revenue and may discourage investment in local industries, especially in the case of high export duties or excise duties. Now, people are saying there are possibilities that there will be reduction in the consumption of carbohydrated goods due to the 10% excise duties imposed on companies operating in this industry. You know what that means? Is that because excise duty is an indirect tax, okay, so it is the consumer of the goods that will bear the burden. Okay, so if you like, the more you consume, okay, let me put it that way, the more you consume, the more you pay. Okay, so let's go to we are still under the classification of taxes, and here we are looking at the perspective of tax base. So what we have just conclude is that of tax subjects. Okay, so perspective of tax base. Tax can also be classified according to what is being taxed. In Nigeria, the following bases are in use: capital, income, and consumption. Capital, income, and consumption. Are we together? Are we together? Capital, income, and consumption. So examples of taxes classified on basis of income are personal income tax and companies income tax. For capital, it is capital gains. Okay, for capital, it is capital gains. The examples of these of the case of consumption are value-added tax and excise duties. Are value-added tax and excise duties. Okay, so in Liberia, we have what? We have the income. Okay, we have the income, and also we have what? We have the consumption tax base. We have the income tax base. We have what? We have the consumption tax base as well, and others. Okay, so let's look at the perspective of distribution of tax burden. Perspective of distribution of tax burden. The following can be identified: the proportional tax. And the proportional tax, the taxpayer in this case pays the same percentage of income as tax. Okay, the proportional tax in this case, taxpayer pays the same percentage of income as tax. Are we together? So, and a good example is what is our income tax. Okay, company income tax. Okay, before it used to be 30%. Okay, but with the Finance Act, it's a kind of mix between proportional tax and progressive tax. So what is progressive tax? For progressive tax, it means what? The more income you earn, the more tax you pay. The more income you earn, the more tax you pay. So another example of the proportional tax is the capital gains tax. So in Nigeria, the capital gains tax rate is at what? Is at 10%. Is at what? Is at 10%. Okay. So and for the progressive tax, we have the personal income tax. Looking at our personal income tax table, we have the first 300 at 7%, next 300 at 11%, next 500 at 15%, next 500 at 19%, next 1.6 million at 21%, and anything above 3.2 million, you have it at 24%. Are we together? And lastly, we have the regressive tax. We have the regressive what? The regressive tax. Here, the taxpayer with smaller income pays a greater percentage of the income as tax compared with a person with higher income. The taxpayer with smaller income pays a greater percentage of the income as tax compared with a person with higher income. All flat rates are regressive. All flat tax rates are regressive. And a good example is the value added tax. A good example is the value added tax. Are we together? Now let's move to the sources of tax laws. Sources of tax laws. The following are the sources of Nigerian tax and Ghana tax laws. The various income tax laws in Nigeria, we have the state and federal laws, including the Federal Government Act and the state government laws. In Ghana, we have the central government as the sole authority to impose taxes and duties, which is done through parliament. We have the Internal Revenue Act 2000 Act 592 governing direct taxes, income tax, capital gains tax, and gift tax. For indirect taxes, we have the Customs, excise, and Preventive Service Management Law and the Value Added Tax Act 1958. Opinion of income tax experts and authors, insofar as the courts take judicial notice of them, court judgments until overruled, departmental and official circulars, accepted recommendations of commissions of inquiry, customary laws, constitution, and practices of the revenue departments. Please note these are sources of tax laws because they may come out in your short answer question or multiple choice question. Okay, again, the following are the sources of Nigerian tax and Ghana tax laws. In Nigeria, we have the states and federal laws, including the Federal Government Act and the state government laws. In Ghana, we have the central government as the sole authority to impose taxes and duties, which is done through parliament. We have the Internal Revenue Act 2000, Act 592, governing direct taxes, income tax, capital gains tax, and gift tax. For indirect taxes, we have the Customs, Excise, and Preventive Service Management Law 1993, and the Value Added Tax Act 1998 at 564. Opinion of income tax experts and authors, insofar as the courts take judicial notice of them, court judgments until overruled, departmental and official circulars, accepted recommendations of commissions of inquiry, customary laws, constitution, and practices of the revenue department. Are we together? Now let's look at the distinction between taxes and levies. Distinction between taxes and levies. The definition of tax provided by Nintigirl, 1997, can best be used to differentiate taxes from levies. Nintigirl described tax as a compulsory contribution imposed by the government, even though taxpayers may receive nothing identifiable in return for their contribution. They nevertheless have the benefit of living in a relatively educated, healthy, and safe society. From this definition, one can affirm that tax is not levied in return for any specific service rendered by the government to the taxpayer. However, levies are paid to the government in return for specific services by government to the taxpayer. For example, a fee, such as court fee, is a payment to defray the cost of the service undertaken by the government, primarily in the public interest, but conferring a special advantage on the taxpayer. Another form of levies is fines and penalties. This is not imposed to collect revenue, but serves as a punishment for those who go against the laws of the land. Example, traffic offenders. Traffic offenders, because it is avoidable. Okay, so at times levies are avoidable, but tax are not what they are not avoidable. You can only plan and manage your taxes. So if you are trying to avoid tax, by all means, it may be seen as a tax evader. Okay, so it follows therefore that while all forms of taxes can be described as levies, since they constitute imposition, not all levies can be properly described as tax. For the purpose of illustration, why the tax imposed by Section 9, subsection 1 of the Companies Income Tax Act, Law of Federation of Nigeria 2004, on profits of companies accruing in, derived from, brought into, or received in Nigeria, or received in Nigeria. Or received in Nigeria can be rightly described as tax. The penalty and fine imposed by Section 85, subsection 1 of Companies Income Tax Act can at best be described as a levy and not tax. Are we together? Okay. So tax, like levy, is involuntary in the sense that its compliance is compulsory, but not intended to be punitive as a levy. Tax must be charged and exerted pursuant to legislative authority that is supported by a particular written law, and if there is an invalid tax law, a charge cannot suffice for tax. If it is backed by a particular valid tax law, it is a tax irrespective of whether it is described as levy or tax. What are the basic concepts in taxation? What are the basic concepts in taxation? Basic concepts in taxation. Basic concepts in taxation. We have the tax base, tax yield, tax rates, tax incidence, tax burden, tax impact, tax shift, and tax effects. Now let's take these one by one. You see, basic concepts in taxation are what are the concepts of taxation, okay, in which will assist in having better understanding of taxation. Okay, so for tax base, this is a measure upon which the assessment or determination of tax liability is based. Tax base is a measure upon which the assessment or determination of tax liability is based. It is that portion of a taxpayer's income or property which is expected to suffer tax. And we have tax yield. This is the return in form of tax revenue derived from the administration of tax on taxpayers. And we have tax rates. It describes the burden ratio, usually expressed as the percentage at which a business or person is taxed. For example, the company income tax rate is 30% and the value-added tax rate is 5%. Please note that these rates, the rates used as example, are the rates prior to the introduction of the Finance Act of 2019. Okay. And we also have tax incidence. It is an economic term for the division of a tax burden between buyers and sellers. It does reveal the person that will pay the tax liability. For instance, if the government decided to impose an increased tax rate on cigarettes, the producers may increase the sale price by the full amount of the tax. If the consumers still purchase cigarettes on the same amount after the price increase, it will be said that the tax incidence fell entirely on the buyers. Then we have tax burden. This is the amount of income, property, or consumption tax levied on an individual or business. Tax burdens vary depending on a number of factors, including income level, jurisdiction, and current tax rate. Income tax burden are typically satisfied by deduction from an individual's payslip each time he or she is paid. For example, the burden of VAT or goods sales tax is on who? Is on the consumer of those goods and services. And also we have tax impact. This is the effect of a tax on the production or consumption of the product being taxed. For example, the tax impact of raising the levy on tobacco might be a reduction in tobacco sales. And we have tax shift. This is also referred to as tax swap. It is a change in taxation that eliminates or reduces one or several taxes and establishes or increases others while keeping the overall revenue the same. And lastly, tax effect. This is a general term that describes the consequences of a specific tax scenario with respect to a particular tax-paying entity. Are we together? Okay. Now let's look at the goods and services tax in Liberia. Goods and services tax in Liberia. Okay, one, we have the goods tax. A goods tax is imposed on the following taxable supplies and imports. Okay, so we have taxable supply of goods. This means any sale, exchange, or other transfer of the rights to dispose of the goods as owner, or an application of goods to own use where the goods were acquired pursuant to an exempt supply or the grant of the use or right to use any goods under lease, a hire purchase agreement, or finance lease. Supply of services incidental to a supply of goods is part of the supply of the goods. Taxable imports. Taxable imports means the bringing of goods into Liberia, a supply of services incidental to an import of the goods. This includes the services giving rise to commission, packaging, transportation, insurance, and warranty costs payable on or by reason of the imports. And then we have orders, and these are amount of tax. Yes, tax payable on supplies and imports is 7% of the amount of the taxable supplies and imports respectively. Person liable for tax. For taxable supplies, tax payable on a taxable supply is to be accounted for by the registered manufacturer making the supply to the minister, while the importer, where the importer is not the registered manufacturer, accounts to the minister. Therefore, the goods tax recoverable from recipients. The goods tax payable by a registered manufacturer is recoverable by the manufacturer from the recipients of the supplier. Payment of goods tax. The goods tax payable in respect of taxable supplies made during a tax period is due on the date the goods tax return for that period is due, and that of a taxable import is due on the date of arrival of the import at the port of entry. Are we together? And then for exempt supply, okay, the followings are exempted from goods tax. One, we have foodstuffs for human consumption for the general use of educational and philanthropic institutions certified as such by the minister, excluding goods for the personal use of the members and employees of such institutions and organizations, but not when served as a meal or as cooked or prepared food. Okay, that's has undergone processing. Okay, also another exempt supply is supply of goods for the relief of distressed persons in the case of natural disasters or other humanitarian emergencies. A supply of pharmaceutical or medicinal preparation, a supply of medical aids or appliances specifically designed for persons with an illness or disability, a supply of textbooks or other instructional materials designed for use in schools or adult educational programs, a supply to a registered manufacturer or to a person in the business of mining or forestry of raw materials or other inputs for use directly in manufacturing or capital goods. A supply of goods as part of transfer of a manufacturing business as a going concern by a registered manufacturer to another manufacturer. So now let's take service tax. Supply of services is the performance of services for another person. Supply of service is the performance of services for another person. Just like taxable supply, okay. Service tax is imposed, such like goods tax, okay. Service tax is also imposed at 7% on every supply of taxable services in Liberia by a registered services provider. The taxable amount of a supply of taxable services is the consideration payable for that supply. Registration of manufacturers or service providers. Before that, note that the taxable amount of a supply of taxable services between related persons for no consideration or for a consideration that is less than the fair market value of the supply is the fair value of the supply. Okay, now let's take registration of manufacturers or service providers. Every person who carries on any business of manufacturing, providing services has obligation to register at the end of any period of 12 months, where during the period the person made taxable supplies, provide services of $5 million or more, or at the beginning of any period of 12 months,
where there are reasonable grounds to expect that the total taxable amount of taxable supplies, services to be made by the person during that period will equal or exceed $5 million. The minister may include in the person's taxable supplies, services, the taxable supplies or services made by another person who is a related person. Every person who has an obligation to register shall apply to the minister for registration within 21 days of becoming so required. Cancellation of registration. A registered manufacturer or service provider shall apply in writing to the minister for cancellation of registration if the person has ceased to make taxable supplies or services, or where the value of taxable supplies or services provided during the most recent 12-month period does not exceed the threshold. In Ghana, the following are notable tax legislations: Internal Revenue Act 2000 Act 592, Custom Excise and Preventive Service Management Law 1993, and Value Added Tax Act 1998. There are various machinery set up by the government to ensure strict compliance of all concerned. Non-compliance with these laws attracts penalties and fines. Again, in Ghana, taxation is administered by the central government. The revenue agencies are the Internal Revenue Service, Customs, Excise, and Preventive Services. And the Value Added Tax Service, VAT, these revenue agencies have a common board, the Revenue Agencies Governing Board, to oversee its operations. Thank you guys for coming to class today. We have successfully come to the end of today's class. And in today's class, we have discussed tax. We discussed the history of tax in both Nigeria and Ghana. We look at the tax administration in Liberia, and we discussed the canon of taxation. Also, we discussed the goods and services tax in Liberia and the basic concepts in taxation. So in summary, tax is a compulsory levy imposed by the government for the purpose of meeting the cost of governance. The benefits accruing to the individual taxpayer do not necessarily have to be commensurate to the amount of tax paid by the individual. Okay, so we have multiple choice questions and we have short answer questions and assignments for you guys. So now let's take the multiple choice questions. The following are the objectives of taxation, except A, to provide physical tool for stimulating economic growth and development, B, to promote healthy competition among different tiers of government, C, for revenue generation to meet the needs of the government, D, to redistribute income wealth in order to reduce inequality, E, to provide income for governments for use of social responsibilities. So all of the options are what are the objectives of taxation, except for B. Okay, so one of the objectives of taxation is not to promote healthy competition among different tiers of government. Okay, so why are they competing? Who are they competing for? Okay, so that's not the objectives of taxation. And two, the following are the examples of indirect taxes, except A, import duties, B, value added tax, C, excise duties, D, withholding tax, E, export duties. The correct answer is D. Withholding tax is not an example of indirect taxes. Hence, it is an advance payment of income tax. Withholding tax is an advance payment of income tax. Okay. And three, the following are the canons of taxation, except A, accountability, B, equity, C, economy, D, ability to pay, E, flexibility. The correct answer is accountability. Accountability is not one of the canons of taxation. Are we together? Okay. And four, we have the following are the sources of tax, except A, opinion of income tax experts, B, court judgment until overruled, C, opinion of a member of House of Assembly of any state, D, constitution, E, accepted recommendations of commission on inquiry. While we are discussing the sources of tax laws in both Nigeria and Ghana. We never mentioned the opinion of a member of House of Assembly of any state to be a source of tax law. Hence, the correct answer here is C. That is, opinion of a member of House of Assembly of any state will not be considered as the sources of tax law. And number 5, tax system includes the following. Tax system includes the following. Tax system includes the following. A, tax law only. B, tax administration only. C, tax policy only. D, tax policy and tax law. E, tax law, tax policy, and tax administration. The correct answer is tax law, tax policy, and tax administration. And that is E. Okay, so now let's look at the short answer questions. One of the purposes of DASH is to raise funds to provide public goods. One of the purpose of taxation is to raise funds to provide public goods. 2, a principle of an ideal tax system that accepts that the structure and rate of tax to be capable of being altered without much difficulty is known as DASH. Flexibility is the principle of an ideal tax system that accepts that the structure and rate of tax should be capable of being altered without much difficulty. 3, the technical name given to a tax borne by a person other than the taxpayer is called DASH. The technical name given to a tax borne by a person other than the taxpayer is called indirect tax. Indirect tax. Are we together? 4, the relevant law that deals with taxation of individuals is what? Is the Personal Income Tax. In Nigeria, we have the Personal Income Tax Act, CAP LFN 2004 as amended. And 5, give any 2 examples of indirect tax. We have the excise duties, export duties, we have the value added tax, we have the stamp duty, among others. Are we together? So we have you guys have an assignment. We have 1, 2, 3, 4, 5. So ensure you attempt these assignments before our next class, and you can send your suggested solutions for review. Thank you guys for coming to class today. Do have a successful diet ahead. Thank you.